Welcome back, everybody. Bjorn, your trusted guide to real estate here in Minnesota. Before we dive into today's topic, I want to make it very clear that I'm not a mortgage lender. My goal today is to provide some background context on how interest rates have evolved over the past 15 years and their impact on the home buying market. For specific mortgage advice or detailed questions, I have a list of trusted professionals that I can refer you to right now. And they can answer those questions. Now that the disclaimer's out of the way, let's jump on in. Let's jump in to the Wayback Machine and head to 2008, actually 16 years ago, when old Bjorn was just finishing up his college degree. In 2008, we're in the middle of a very weird financial crisis. So the Federal Reserve took drastic measures to stabilize the economy by cutting interest rates to, at the time, historic lows. This meant that mortgage rates dropped significantly, often below 5%, making home buying much more affordable for people. So we saw a little uptick in the market. From 2011 to 2015, we saw those low rates continue. A 30-year fixed mortgage fell to below 4%. This period was great for buyers and homeowners looking to refinance, as low rates encouraged both purchasing and those refinancing activities. Now let's fast forward to 2016. The Fed began to slowly raise rates as the economy recovered. Mortgage rates climbed modestly, reaching around 4% on average by the end of 2017. This increase wasn't huge, but it did start to affect how much buyers could afford. By 2018, the rates peaked around 4.5%, and the housing market began to feel the impact with a slight slowdown in activity. Now, was that in every market? No, some markets remained very hot. We're looking at the nation as a whole, though, and we saw a little bit of a slowdown. And then in 2019, rates, well, they dipped again due to the Fed cutting rates to address global uncertainties. What they didn't know is what was coming up right around the corner. And in 2020, things definitely changed. The COVID-19 pandemic era led to now record low mortgage rates, often below 3%. This was a fantastic time for home buyers and those looking to refinance. This drove a boom in the housing market, as we saw. A lot of people were buying houses. A lot of people that weren't ever in consideration of buying houses are now buying houses. In 2021, things kept cracking with those low rates, and it fueled a competitive market with rising home prices due to the high demand. More people were buying than the amount of houses were out there. Simple economics. But by 2022, the Fed said, well, hold on. Let's combat that inflation a little bit. And we saw mortgage rates start to climb around 4 to 5%, which started to cool the market a little bit, as buyers' borrowing costs affected affordability. The higher that interest rate is, the less you can borrow, the less home you can buy, right? And so now that brings us closer to the present day. In 2023, interest rates continued to rise as the Fed took further action to manage inflation. Mortgage rates have surpassed 6%, a big jump from the lows we saw just a couple years ago, right? This rise has had a noticeable impact on the housing market. Affordability has become more of a concern, and we've seen somewhat of a slowdown in the home buying activity, but again, like in the market here in St. Cloud, not as much. In the market in the metro area and the cities, not as much. People are still looking for homes. With higher rates, monthly mortgage payments have been increased, which means buyers can afford less than they could before. This also cooled down the rapid price growth we saw during the low rate era. The sidebar here is, if you're looking to sell your house, those prices haven't dropped. They just haven't continued to go up at such an incredible rate. So, there you have it. A look at how interest rates have shaped the housing market for the past 15 years. From record lows to recent hikes, these changes have most certainly had an impact on home buying affordability and market dynamics. Now, with all that information, here are some important parts to remember. If you need a home, you need a home. Renting is essentially 100% interest if you think about it. When you're ready to buy, it's a great time to connect with the lender and explore your options. And don't forget, when you get that loan, you can always refinance in the future when market conditions change, which, if we look at just the past 15 years, I promise you they will, almost certainly. But here's something to keep in mind. When you do see these rates posted, for example, XYZ Lending posts on social media that rates are at 6.9%, that's really just an average. Different lenders offer different products, and your specific rate can vary. Your mortgage interest rate depends on several factors like your credit score, the loan type, the loan term. Higher credit scores and larger down payments get you a better rate. Other factors like debt to income ratio, loan amount relative to property value, and the current market conditions also have an impact on those rates. So, how do you figure out what your interest rate will be? It's simple. After you find a quality agent, which is step one, comes step two, which I've talked about a lot. Get yourself pre-approved. I've covered it in so many videos in the past, and you'll hear me talk about it again in the future. Don't worry. But getting that pre-approval done will give you a really, really clear picture of what your interest rate will be. So, if you're navigating the current market or just curious about these trends, I hope that this overview helps you understand the bigger picture. As always, if you have any questions or need more insight, reach out or use those comments below and let's get a discussion going. Thank you so much for tuning in. Don't forget to like and subscribe so you don't miss any of these updates and great real estate tips and insight that I'm giving you. I'll be back next week with more great information to help you navigate the ever-changing real estate market. So until then, be kind to one another.